Chris, thanks very much for coming through. Many people have raised the eyebrows at the fact that an IMF loan that was directed at infrastructure, 50% of it will be going towards shoring up foreign exchange reserves.
Yes, that's a serious cause for concern. Makes you wonder what really the central bank does with its reserves, why it needs the reserves, and why it needs to borrow money to shore up reserves.
Well, the central bank, we know, has tended to intervene in the money markets to try to bolster the shilling recently with dollar sales. They haven't done so excessively in the recent past, but they could argue that they had to get in and defend the currency.
Well, as a matter of fact, the central bank has weakened the shilling. Their purchases of, I think, in excess of $150 million, coupled with the fact that they did not sterilize in the money markets, has actually weakened the shilling. And this is what the market is up in arms about, because it clearly looks like an intervention as opposed to reserve accumulations.
Now, Kenya argues that they've got 3 months import cover, whereas the legal requirements is 4 months. And then now that you're all part of the East African Community Protocol, the requirements is 6 months. Why is the East African community introducing such stringent regulations on foreign currency? And is the region in a vulnerable position?
Well, the other East African countries are pretty close to the convergence criteria. And I guess that's the reason why they feel that the whole block should be at 6 months. I think it's quite drastic. A move from, like for instance, Kenya's position from 3.4 months to 6 months would be quite significant, and it would actually keep the shilling on the back foot. Is the region in a vulnerable position? I do not think so. Most of these markets are pretty much liberalized. They don't rely on the central bank for provision of foreign currency. So I would hazard a guess that we probably are not in a position that would worry anybody.
All right, you mentioned the shilling, and we know that other pressures on the shilling would be inflation in Kenya. And although the central bank is quite bullish about growth and inflation being subdued going forward, others are raising concerns about the fact that pressures do exist from rising fuel and food prices going forward. What are your projections for the shilling?
Well, I think if you look at the picture on the ground, taking out the two issues you've mentioned, the fundamental picture looks pretty decent. I would predict a stronger shilling going forward. I think next year, I mean, if indeed the central bank are genuine and the $250 million they're receiving is for reserve management, they would need $250 million less from the market, and that would be a significant cause for the shilling to rally. If you add on to the fact the rosy, or rather rosy-looking fundamental picture, I think one begins to realize that we could be in a period of a sustained recovery for the shilling.
Now, Kenya's foreign reserves are said to be in the region of $3.4 billion, which, I mean, if you compare to other big economies in Africa, Nigeria and South Africa, it's fairly low. But it could be argued you're not a commodities exporter, and so you couldn't have earned a lot from your exports. Nonetheless, exports are booming in the agricultural sector. Tourism figures have peaked, and these are major sources of foreign exchange earnings in Kenya. What more can be done to support the forex position?
Well, in addition to that, I think the country needs to look at its manufacturing industry. I think we need to probably strengthen the manufacturing base of the country, make the country a more effective place for doing business. Energy costs are high, infrastructure costs, infrastructure challenges exist. I think we need to relook the traditional exports that the country receives. The old adage that tea, coffee, and tourism will be our bedrock needs to change. I think we need to relook at where we get our foreign exchange flows, probably orient ourselves towards industrial base and target the larger East Africa and the larger African markets that exist.
And then finally, Chris, last week we did see the CBK enter the market twice on Monday and Thursday, each day buying about 5 million euros worth. Now, we know that the shilling often tracks the euro because Europe is Kenya's largest trading partner. But what we've seen in the Eurozone, obviously with the debt crises in Ireland and other southern European countries, is that it started to have a very negative impact on the euro. As the government tries to shore up its foreign exchange position, in the context of what's happening in Europe? How susceptible is the effort to shore up foreign exchange reserves when you've got a shilling that's so closely intertwined with the euro at this time in particular?
Right. The fact that the shilling is correlated, or rather appears to be correlated to the euro, is a very questionable strategy. I think it's pretty much laziness on the part of Kenyan traders. The fact is that the euro-Kenya shilling correlation cannot be proved using backtesting. It's at best questionable. So the fact that the Eurozone is in trouble is something which we need to go beyond. The fundamental picture in Kenya and the fundamental picture in Europe are totally different. Unless we see a significant shock out of Europe, some new news other than the pigs, I don't think we need to be concerned.
Okay, thanks so much to Chris Muiga, who's a senior currency dealer at KCB. Now, Kwebi, let's talk about this situation because some would say it's cause for concern. South Africa is needing to intervene in terms of weakening the South African rand in order to try to bolster exports, which have dropped by 20% in recent years. Nigeria has seen a situation where the CBN has been active in the market trying to keep the naira stable in the 150 range, and they've had to really draw in from the war chest of reserves, and now there's a concern about dwindling reserves, and now the situation in Kenya where an IMF loan is being used to shore up reserves.
I mean, before I answer it, I'm surprised the IMF is still giving out loans to the old third world, and which is now the emerging world. I mean, if you just look, for instance, at the last Ireland thing, okay, Ireland, they've just written a $22.5 billion facility for Ireland, whereas, Kenya, on the other hand, gets a $500 million loan, which is actually quite small, and it's a very, very tiny little loan relative to what they're actually spending in Ireland at this stage. That's on the back end of that. Think about it like this. The Western world at the moment is liquefying their currencies. So they've got to print money in order to make sure there's enough money around and enough money supply around so they can try and create inflation. So you've got that happening in the Western world. And then on the other end, you've got an emerging world sitting and not doing that. And they're trying to be pro-business because there's nothing wrong with their economies. So the net result is that you've got very, very strong currencies in emerging market currencies, of which Africa is a prime example. There you've given me, there you've looked at some good examples. Nigeria, South Africa, and now Kenya, as far as that's concerned. What happens beyond this? Well, you can't continue to defend your currency because you're going to run out of money defending your currency because you're up against very, very large economies across the world. What do? Well, you've got to become more nimble and you've got to become more able and you've got to look at other ways that you could potentially compete. And you've got to understand that as an emerging market player, your currency is always going to be at the whims of much larger players. What do you do in your economy in order to safeguard yourself against this? And what kind of industries do you promote in order to do so? And that becomes something that every country needs to start asking.
Obviously, at a time like this, when you've got some unfavorable shifts in currencies, especially global reserve currencies like the euro and the dollar, questions emerge about hedging strategies that are available, especially in the emerging market economies. What can central banks in Africa do? Because as you're saying, we're entering an industrial phase where we're going to be exporting more, and with the imports to support the industrial process, we're going to need to be paying for goods in foreign currency, and we need to be drawing from these very reserves.
You see, I think for African economies, and I mean Asian economies do this quite well, is where they sit down and they say, let's create different sources of income into an economy. So some of it might be a consumer base, and some of it might be an industrial base, and some of it might be a commodity base. South Africa is a good example of that. So if your commodity base shuts down because of a very strong currency, or becomes less productive because, or less economically viable because of the exchange rate, maybe you've got a consumer base that could potentially take up the helm and grow GDP. So you've got various components that could potentially drive GDP in the country. But when you've got a one-horse bet, so to speak, what do? Well, it either is going to do great and then you're going to get the benefit in the economy, or it's going to do terrible and you're not going to get the benefit. And that's the problem that you face at the moment. And you've got to try and work through those without trying to manipulate currency, because once you manipulate currency, then the rest of the Western world goes and sits and says, well, sorry, these people manipulate currency. How can we trust that this is a free float currency? Which is what we're sitting with between the US and China at the moment.